What if the United States just lost control of $6.1 trillion in global trade and didn't even see it happen? On May 26th, China didn't fire a shot. It issued a silent directive to its banks, cancelled dollar trade, moved to the UN. Now, overnight, countries started pricing oil, steel, and machinery without touching a single US dollar. And while Trump demanded Beijing exports, China drew a red line. We'll trade, but only on our terms. This isn't a tariff war, it's a financial mutiny. And the next move might erase America's grip on the world economy for good. On May 26, 2025, while US officials were still urging Beijing to rebalance its economy, China quietly rewrote the rules of global trade. The People's Bank of China raised the minimum Renminbi ratio in cross-border transactions from 25% to 40%, effectively sidelining the dollar in deals worth over $6.1 trillion annually. This wasn't symbolic. As Bloomberg reported, Chinese banks that fall short risk regulatory downgrades, limiting their access to capital markets. Goldman Sachs now projects that every 1% appreciation in the Yuan could lift Chinese equities by 3%, underscoring the financial gravity this policy shift is already generating. But what Beijing did next signaled an even more aggressive shift in power. And it wasn't about cooperation. At the Global Finance Forum, US Treasury Secretary Scott Bessent accused China of destabilizing global trade and demanded it manufacturing in favor of domestic consumption. But Beijing didn't flinch. It pivoted. Instead of pulling back exports, China is preparing to expand them under a rebooted Made in China strategy, with focus on AI, robotics, and semiconductors. According to sources cited by Bloomberg on May 26, manufacturing currently contributes 25% of China's GDP, and officials made clear it's non-negotiable. Rather than accept a binary framework, produce less, consume more. Beijing aims to grow both sides of the ledger. And as long as that growth is denominated in Yuan, Washington's control over trade terms weakens. But what does this mean for the financial markets betting on dollar dominance? This isn't a tantrum, it's a structural pivot. By forcing more trade into renminbi, China is shielding itself from dollar-L sanctions, while actively drawing global capital toward its domestic markets. In Q1 2025, cross-border yuan settlements accounted for 30% of goods trade, up from under 20% just 2 years ago, according to Pang Gongsheng, governor of the PBOC. Analysts at Reuters estimate that shifting another 10%, roughly $610 billion into yuan, could boost long-term demand for Chinese assets by 12%. As renminbi trade rises, the recycling loop shifts away from US treasuries, draining liquidity from American bond markets. The immediate impact, lower demand for the dollar, tighter capital flows into Wall Street, and an incentive for foreign institutions to hedge in yuan. But China's real advantage lies in who's buying in and who's no longer listening to Washington. Picture yourself in a Johannesburg electronics store. You pick up a generator, Chinese-made, cost-efficient, and labeled not in dollars but in yuan. This is no thought experiment. As of Q1 2025, BRICS trade with China surged to 1.49 trillion yuan, roughly 209.7 billion USD, up 11.3% year-over-year per China's General Administration of Customs. Deals with South Africa, Iran, and Brazil are increasingly settled in local currencies or yuan, bypassing the dollar entirely. In the background, tariffs. Trump's latest hikes reached 145%, forcing partners to look for alternatives. As payment rails shift, so does pricing, making the dollar not just politically toxic, but economically inefficient. But if buyers are switching currencies, what are exporters doing with their loyalty? While US officials push a Fortress America narrative, China's trade ecosystem keeps expanding with willing partners. In the first quarter of 2025 alone, Chinese exports to Brazil jumped 25.7%, while imports surged 30.1%, marking a record bilateral expansion. Trade with Russia also intensified, especially in energy and machinery, as detailed by Reuters. The reason: predictable pricing, fewer political strings, and Yuan-denominated contracts that don't expose countries to US regulatory blowback. Liu Daliang of China's Customs Department noted that BRICS now accounts for 20% of global goods trade, and this bloc is becoming an accelerator for de-dollarization. The contradiction is stark. Washington's sanctions are pushing allies closer to Beijing's financial system. But what happens when the dollar isn't the world's default anymore? And who risks the most? When Trump raised tariffs to 145% in early 2025, it was framed as economic defense. But instead of forcing a slowdown, China's manufacturers pivoted and got cheaper. According to Bloomberg, Chinese heavy machinery exports surged by 18.4% in the first quarter of 2025. Despite domestic real estate contraction, state-supported firms like Sana and XCMG shifted capacity from stalled domestic projects to aggressive overseas sales, undercutting global competitors by up to 50%. The Wall Street Journal reported that construction vehicle shipments to Africa and Southeast Asia hit record highs, with Yuan prerequisite contracts bypassing tariff exposure altogether. By using scale and state leverage, China didn't just survive Trump's squeeze, it sharpened its competitive edge. But how far can this price advantage stretch if Beijing controls the currency too? If Renminbi becomes the new default for trade, does the dollar even matter outside US borders? In April 2025, China settled over 40% of its BRICS trade in yuan, up from 29% the year prior, according to PVOC filings. That's not just volume, it's velocity. Countries like the UAE and Egypt, now BRICS members, are signing infrastructure deals directly in Yuan, avoiding US financial systems altogether. Meanwhile, Saudi Arabia is reportedly reviewing oil contracts denominated in Renminbi, a leaked draft cited by Reuters. This isn't just cost efficiency, it's insulation from US sanctions. So let me ask you, if Beijing can offer fast settlement, fewer restrictions, and no political strings, who has more leverage in a global deal? Drop your answer in the comments, because what's happening next may shift that equation even more. Beijing is dismantling the dollar's monopoly without confrontation by building an alternative system. According to the Financial Times, over 60 countries now use China's CROSPER interbank payment system, CIP, and transaction volume jumped 27% year-on-year by March 2025. This parallel to SWIFT processes payments in yuan across Asia, Africa, and parts of Europe, effectively shielding partners from dollar volatility and US scrutiny. At the same time, China's sovereign digital currency pilot expanded to 14 new trade zones, making settlement even faster and harder to trace via Western institutions. This isn't a protest, it's an infrastructure play, and each transaction that clears outside the dollar weakens its role not through policy, but through obsolescence. So, how exposed is Wall Street if this trend accelerates? US asset stability relies on one thing: the world needing dollars. But if China absorbs more trade into the UN system, capital will follow. According to Goldman Sachs, a sustained 10% increase in UA-denominated trade could reduce foreign demand for US treasuries by $210 billion annually. That's not theory, it's velocity bleed. Bloomberg's bond tracker shows a 12% drop in Asian institutional holdings of US government debt in Q1 2005 alone. Meanwhile, central banks in Indonesia, South Africa, and Iran are increasing their Renminbi reserves. According to IMF disclosures, this shift challenges more than just currency dominance. It undermines trust in US financial continuity. If dollar reserves no longer guarantee access or stability, global capital starts looking for new anchors. But if Wall Street no longer anchors global capital, what fills the vacuum? China isn't waiting to be invited to the table, it's building its own and rewriting the guest list. From dictating settlement terms to routing capital flows, Beijing's dollarization campaign isn't theoretical, it's operational. But if sidelining the dollar was phase one, what's phase two? Because leaked policy memos suggest China may now link its sovereign digital currency to trade pricing, locking in buyers and cutting out FX markets entirely. That's not just currency strategy, it's global financial engineering. So if you think this was the hard part, think again, because what China does next could upend the entire monetary architecture. We're glad you're enjoying this video. Please like and subscribe.